Hello, Sam Markowicz from Schroders. Can you explain us a bit more about your view about US superstars?
So a handful of large technology companies increasingly dominate their respective industries in terms of stock market returns, in terms of sales, and in terms of profits. And this has important implications for investors because these firms have driven stock market returns higher over the last 20 years. But this has meant that concentration in the stock market has also increased. Passive investors have done very well because of the strong performance of these companies. The problem now is that with concentration increasing, the tide may be soon set to turn, and this could expose these investors to a new risk. That's why it's important for investors to have the flexibility to discriminate between the potential winners and the potential losers.
And what's your view for the coming years? Will the current top five, like Facebook, Apple, Google, etc., will stay in the top five?
That's a big question. On the one hand, regulation uncertainty is on the rise. Some of these companies may be affected by the scrutiny that they face regarding data protection laws. Google and Facebook stand out in that regard, and antitrust investigations into those firms are already underway. And history suggests that regulatory uncertainty could impact their valuations. But on the other hand, these companies have such a strong foothold on their market, and they continue to innovate. And this has deterred other firms from penetrating their markets. So if we do see regulatory scrutiny come into focus over the coming years, it might be the case that these companies may not be able to maintain that market dominance anymore, and then we might see these companies displaced.
Would you then recommend investors to diversify and not only buy the top five superstars, but also buy smallest companies? Because most of these top five superstocks are at record levels, I think.
Diversification of portfolio returns would be a strong way to mitigate against these risks. We've seen over the past few years that a handful of these firms have contributed a big part of the returns of passive portfolios. But that assumes that yesterday's winners will continue to be tomorrow's winners, and it's the passive investors that construct their portfolios in that regard. We would argue that having the flexibility to conduct rigorous analysis on these companies would allow investors to manage the dangers that might lie ahead.
When we look to other sectors, in the tech sector, you said the top five is extremely dominant. Do you also see this in other sectors? A very strong top five or top 10?
Well, pharmaceutical stocks stand out as another sector that has grown increasingly powerful. These are a set of companies that have also come under regulatory scrutiny, particularly because of the high drug prices that are evident in the US. And Elizabeth Warren, the presidential candidate for the Democratic nomination, has been quite critical of these companies. So it's possible that they could come under the regulatory crosshairs as well.
Okay. Thanks for the interview.